Welcome to Iron Financial, the place where we forge stronger portfolios. Today, we're putting on the hard hats, grabbing the blueprints, and we are inspecting an absolute giant of the industrial world, Illinois Tool Works, ticker ITW. Now, this is the company making the guts of modern life. The welding gear, the car parts, the food equipment, you name it, they're probably involved. They have built this incredible reputation as a fortress, a bastion of stability and shareholder returns. But the real question, the one we're here to answer today, is simple. Is its stock a truly solid foundation for your money?
And let me rephrase that. Is it a fortress, or is it just another heavy, slow-moving behemoth that's about to get stuck in the mud of a slowing economy? Look, everyone loves to throw around the word quality these days, but let's be absolutely real. Quality at the wrong price isn't an investment, it's a trap. So today, we're going to cut through all that noise. We are going to stress test this structure, and we're going to find out once and for all if ITW is the real deal, a true fortress of an investment, or if it's just a fancy facade that's waiting to crumble.
All right, here's the game plan. We are running a full structural inspection today, and we're leaving no stone unturned. First, we'll examine the company's reputation for strength, the view from the outside. Then we're going inside to look at the core blueprint, their famous 80-20 model. After that, we put it all to the stress test with their latest performance numbers. We'll check the reinforcements, and trust me, there are billions in reinforcements for shareholders. And finally, we'll look at that all-important price tag and decide if the cost of entry is actually worth it. Let's get to work.
Okay, first things first, let's just admire the structure from the outside. You have to respect it. You don't get to be a $71 billion Fortune 300 global leader by accident. It just doesn't happen. ITW is this massively diversified manufacturer with 7 different segments, and over the last decade, it has built an absolutely rock-solid reputation for delivering exactly what investors want: solid growth, best-in-class margins, and just powerful returns on capital. This isn't just talk, it's a result of a very deliberate, very long-term strategy. And that strategy really kicked into high gear in 2012. Their enterprise strategy was like a massive reinforcement project on an already strong building. The results, well, they speak for themselves. Let's be crystal clear about these numbers. Over a decade, they boosted their operating margins by more than 900 basis points. I mean, think about that. That is a colossal feat of efficiency. They more than tripled their earnings per share and their market cap. They multiplied their dividend by 3.7 times. And here's the crucial point. Their compound annual total shareholder return beat not only their industrial peers, but the S&P 500 itself. This is the foundation of their fortress reputation. This is the track record they are selling you.
Okay, hold on. Every company has a fancy strategy name. Enterprise Strategy, Project Everest, Synergy Forward. It's all just corporate jargon until you actually look at the blueprints. So let's do that. What is this so-called ITW business model they're so proud of? What's the secret sauce that supposedly delivered those incredible numbers? Is this real engineering we're talking about, or is it just a slick marketing gimmick?
It's built on 3 core pillars that they apply, and this is key, systematically across all 86 of their divisions. First, and most importantly, is the 80-20 process, which is their core operating system. We'll dig into that in just a second. Second is what they call customer-back innovation. It means they don't just invent things in a lab, they go to their best customers, find their biggest problems, and solve them. This approach has led to a massive portfolio of nearly 21,000 active patents. Third is a decentralized entrepreneurial culture. They want their divisions to act like small, hungry businesses, fast, focused, and responsive. But the real engine room, the thing that powers this entire machine, is that first pillar, the 80-20 process.
All right, so let's get down to it. 80-20 is basically a fancy way of saying they fire their small customers. They focus on the 20% of their clients that deliver 80% of the revenue, and they cut the rest loose. The company itself says it's about eliminating, and I'm quoting here, cost, complexity, and distractions associated with the less profitable opportunities. So my question is this: does this actually build anything for the long term, or is it just a short-term cost-cutting tool that squeezes the company dry? I mean, you can't shrink your way to greatness, right? Where does the growth come from if you're constantly cutting away at the 20?
An excellent question. And honestly, that is the central tension of this entire business model. You've hit the nail on the head. The only way to know if a blueprint is truly sound is to stress test the finished structure under real-world pressure. So let's do exactly that. Let's look at the latest numbers from their Q4 2025 earnings report and see how this fortress is holding up right now.
Okay, now what's really fascinating about this slide is the margin story. The walls are holding strong for sure, But look at the leverage here. Just follow the table down. Revenue is up a pretty solid 4.1%. Not bad, but that intense operational focus, that 80-20 model, translates that into even stronger profit growth. Operating income jumps 5.2%, and by the time you get to the bottom line, diluted EPS, it's up a full 7%. Now, how do they do that? Simple. Their operating margin hit a record 26.5% for the quarter. That means for every single dollar in sales, they're keeping more as pure profit than ever before. This is the 80-20 model in action, and it is delivering best-in-class profitability even in a complex macro environment.
And you better believe management is taking a victory lap, as they should. The CEO, Christopher O'Hurley, highlighted the disciplined execution across all 7 segments. But a fortress isn't just one big uniform wall, right? It has different sections, different towers, and not all of them are equally strong. So let's look a little closer at those individual segments.
And this, right here, brilliantly illustrates where we find the first real cracks in the armor. Now, these are Q3 numbers, but the Q4 report just confirmed the trend. This fortress is not uniform. While the automotive OEM segment is growing at a strong 5% and welding is doing fine, you have to look at construction products. It's actually shrinking, down 2.3%, and the latest Q4 report showed it declined again, this time by 3.5%. Are we really surprised by this? I mean, with interest rates choking the housing market, of course their construction segment is taking a hit. This isn't a picture of universal, monolithic strength. This is a picture of uneven performance, with key parts of the business actually dragging on the whole.
And they know this is a weakness. Don't just take my word for it. Listen to the company itself. Their entire next phase strategy, which they just started in 2024, explicitly makes organic growth its #1 highest priority. They say they want to build organic growth into a, quote, core ITW strength on par with our best-in-class financial performance. Well, that's a direct admission that it isn't a core strength right now. They're literally trying to patch the very cracks we're seeing, which tells you those cracks are very, very real.
Fair point. That's a very fair point. The growth story is lumpy, and they are clearly working on it. But while they work on that organic growth, they are massively, and I mean massively, reinforcing the structure for the people already inside, the shareholders. And they're doing it with an absolute fire hose of cash. Let's talk capital returns.
And look, this isn't just some recent phenomenon. Let's look at the track record. Between 2018 and early 2022, they executed a huge $3 billion share buyback program. That is a gigantic amount of stock taken off the market, systematically reducing the number of shares available and concentrating ownership for every single remaining shareholder. It was a clear, unambiguous signal to the market. We generate tons of cash, and we're using it to directly reward you. And they didn't even pause to catch their breath. The moment that program ended, they immediately authorized another $3 billion buyback, which they just finished up at the end of last year. Think about that for a second. That's not a one-off event. It's a consistent, multi-year strategy of just shrinking the share count. This tells long-term investors that management is relentlessly focused on boosting shareholder value. That's $6 billion in just a few years.
And they're not done, not by a long shot. They're doubling down. In August of 2023, they announced a new, even larger $5 billion program. As of the end of last year, they still had $3.5 billion left to spend. This is that fire hose of cash I mentioned, a powerful, mechanical boost to earnings per share that directly rewards long-term holders, and it happens completely independent of the daily swings of the stock market.
Okay, the buybacks are huge, I will absolutely give you that. And 62 consecutive years of dividend increases is incredibly impressive. That makes them a dividend aristocrat, an elite club. Now let me ask the really tough question here. Is this strength, or is it a sign of a mature industrial giant that has simply run out of innovative ideas for growth? Is this a company aggressively rewarding shareholders, or is it a company that just can't find anything better to do with its cash? Are they just handing it all back because they can't find a way to expand the territory anymore?
And that right there is the billion-dollar question. You have this high-quality, shareholder-friendly, cash-gushing machine. But what is the price of admission? In this market, quality commands a premium. There's no doubt about it. The question for any new investor is, how much of a premium are you willing to pay? Is the price tag so high that it completely negates all the positives we've just talked about? A premium is one thing, but flat-out overpaying is another. And the number suggests you might be doing just that right now. Let's look at 2 different analyst views. Sure Dividend, writing in May of 2025, put a fair value on the stock of $231. At the time, it was trading at $243, or 105% of that fair value. They explicitly warned of a potential valuation headwind, which is analyst speak for the high price could drag on your future returns.
Another view from Webull in October is a little more optimistic, seeing maybe a 5% upside. But even that is hardly a screaming buy, is it? The bottom line is, this stock is trading at or even slightly above what most analysts think it's actually worth. So where's the margin of safety for a new investor? Where's the deal?
All right, the inspection is complete. We've seen the strong foundation of historical outperformance. We've examined the impressive blueprints of that 80-20 model. We've seen the massive steel reinforcements of their capital return program. But we've also identified the very real cracks in the growth story and the very steep price tag hanging on the front door. So let's lay out the final verdict.
The bull case is clear and it's very compelling. This is a high-quality, exceptionally well-run industrial fortress. Its 80-20 model is a proven machine for generating best-in-class margins, period. It has a long and documented history of beating the market. It's returning billions upon billions to shareholders through buybacks and a dividend that has gone up every single year for over 6 decades. Their latest quarter was solid, and their guidance for 2026 is positive. For an investor seeking stability, income, and quality, and who is willing to pay up for it, ITW looks like a solid cornerstone for a defensive portfolio.
But the bear case is just as compelling, if not more so. Even the strongest fortress on Earth can be a bad investment if you overpay to get inside. The slowing, uneven organic growth is a genuine concern, and the fact that the company itself has made fixing it their new top priority proves it. The massive buybacks could be seen not as a strength, but as a mask for a lack of innovative growth engines. And that valuation, it leaves absolutely no room for error. You are paying a premium price today. So for investors who are hunting for value, or for those who need more than just low single-digit organic growth, ITW could be a classic value trap, a very high price for a potentially low-growth future.
So, the crucial question, the one it all boils down to, is this. What are you building? Are you building a defensive portfolio that's designed to withstand any economic storm where paying a premium for undeniable quality is acceptable? Or are you building a portfolio for aggressive expansion where you absolutely need growth and a margin of safety on price? The final decision really rests on your personal strategy, and that's the question you have to answer before you even think about buying a stock like this. That's our analysis. The facts are on the table. It's a premium company at a premium price. Now it's up to you to do your own homework, your own due diligence, and cut through the weakness in your own portfolio. Thanks for joining us at Iron Financial.